Friends, let's be honest. Does the market actually grow right now? Or are we watching the biggest AI bubble in history? Why is the S&P 500 flying up if 90% of companies admit that AI hasn't given them any profit? Why is 75% of all index growth based purely on expectations rather than real money? And what happens when this illusion breaks? Will the stock market fall? Will it crash crypto? Will it hit ordinary people who are barely holding on with loans and rent? Today, we're not asking, is there a bubble? We're asking, when and how painfully can it burst? Subscribe and let's dig into it.
3, 2, 1, fire!
Before we start, this is not financial advice. Everything I say is my personal view and judgment. Use it as an additional perspective, not as a call to action. Let's start simple. Today, around 35% of every dollar invested in the S&P 500 sits in a tiny group of AI giants: NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Tesla. On paper, the index looks strong, but in reality, this isn't a broad US market. It's a handful of corporations carrying everything on their backs. IT investment as a share of GDP is already creeping back to dot-com bubble levels. Investors are valuing AI companies as if they already generate around $2 trillion in yearly revenue, even though real income is far smaller. Prices are built on an everything goes perfectly scenario. No failures, no regulation shocks, no infrastructure delays. That never happens. Now look at NVIDIA. Last quarterly report, ending October 2025, around $57 billion revenue in 3 months, plus 62% year over year. More than $51 billion from data centers and AI chips, forecast around $65 billion next quarter. Demand is real, money is real, the company prints revenue, but the market values it as if this growth rate will continue forever. No competition, no regulation cuts, no slowdown. That's the classic bubble profile. A strong real trend plus expectations that grow even faster than the business itself. OpenAI is the symbol of this era. Valuation around $500 billion, plans to spend roughly $1.5 trillion on infrastructure, expected loss in 2025 above $8 billion. Even Sam Altman openly says the market behaves like a bubble. But capital keeps flowing in because everyone plays the same game. Get in before the music stops. Where do these billions even come from? A significant part of AI infrastructure is financed not by real profit, but by circular funding and hidden leverage. Microsoft pours billions into OpenAI. OpenAI buys Azure capacity from Microsoft. Both sides show revenue growth. NVIDIA invests in or lends to those who then buy NVIDIA GPUs, including CoreWeave and other data center operators. On paper, it looks like insane demand, but part of that demand is created by the suppliers themselves. Much of the GPU data center spending is hidden inside SPVs and private credit. The debt is real, but on official balance sheets, it looks softer. Nothing new. In the 19th century, the US built railway miles into nowhere just to issue new bonds. In the 2000s, they overbuilt fiber networks that stayed empty for years. Today, data centers and AI infrastructure play that same role. Now add physical limits. To power all the planned data centers, you'd need enormous amounts of electricity and water. Some states already warn they cannot handle it without major grid upgrades. OpenAI and partners propose energy consumption equivalent to dozens of nuclear plants. But building such capacity fast is impossible. Infinite growth models hit a physical ceiling. Meanwhile, the government locks itself into this narrative. Budget deficit rises. Debt sits near 120% of GDP. Interest payments may surpass defense spending soon. For policymakers, AI is becoming a last hope. If AI doesn't boost productivity, there's no way to patch the debt hole. Deutsche Bank wrote directly, "Without AI investment, the US economy would already look like a technical recession." And now something fresh. FOMC minutes from late October show almost all members support stopping balance sheet reduction, QT, on December 1st. The Fed is preparing to slow aggressive liquidity tightening. Some want future rate cuts, others prefer holding. Uncertainty remains, but the market reads the key message. tightening is slowing, so more fuel may be added to the bubble. By the way, if you want to get equity market news and breakdowns earlier, subscribe to my Telegram channel. Link will be in the description. Important. This isn't 2000. Back then, most tech companies burned cash and lived off debt and new rounds. Today's AI beneficiaries have massive cash flows, cash piles, diversified businesses. Microsoft, Meta, Amazon, Apple, Alphabet, Nvidia, they can finance AI experiments for years using their core revenue and survive dozens of failures. S&P 500p/E is around 30 now. Expensive, but not 46 like at the dot-com peak. Companies generate far more free cash flow relative to market cap than in 2000. Add record buybacks. Apple, Meta, Alphabet mechanically push prices higher even if real business growth slows. The problem is elsewhere. First, household wealth tied to the stock market is at record levels. Almost half of American families' financial assets are in stocks, ETFs, pensions. If the AI bubble triggers a correction, it hits pensions and savings, not just traders. Second, the US has far less fiscal room than before 2008. Debt to GDP high, deficits large. Repeating the QE plus stimulus checks plus mass bailouts formula will be much harder. And that's exactly why the market scrutinizes every hint in the Fed's protocols. The fact that nearly all committee members support halting QT is perceived by the market as a signal toward a softer policy stance. Even if there's no consensus within the FOMC regarding the rate itself. Third, the shadow system grew. Private credit is now a multi-trillion-dollar quasi-banking sector. Stablecoins add another shadow layer. If something breaks, everyone runs to the Fed again. In 2008, the Fed showed it would save not only formal banks, but shadow structures too, if they're too big to fail. Those shadows are even bigger today. If the AI bubble becomes the trigger, pressure on the Fed will come from all sides, from banks and private credit to major tech companies, which are already being referred to as critical infrastructure. Big players act accordingly. Buffett built record cash and reduced exposure. Michael Burry placed huge bets against key AI rally beneficiaries, including Nvidia. These aren't people who panic on corrections. They look at system balance and say, overheating risk is too high. By the way, what do you think about Burry's move? Is he right? If the AI bubble bursts, first wave hits all risk assets, stocks, high-tech, crypto. During panic, investors want cash. Bitcoin will drop with the market initially. No illusions here. But in the long run, this isn't about tech is bad or crypto is guilty. This is about a fiat system trying to solve debt and productivity problems by inflating a new bubble. Yesterday, it was dot-coms. Before that, real estate. Today, AI, hidden debt, SPVs, private credit, issuance wrapped in the shiny packaging of financial innovations. All of this points to a system living off future debt. In this reality, Bitcoin remains the only major digital asset with fixed supply, one that can't be printed to bail out corporations or shadow funds. If the crash is tied to debt instability and fiat system reset, not just recession, BTC has a strong chance to decouple and become a trust haven. Ethereum, despite AI narratives through Layer 2, RWA infrastructure, still has real value. Decentralized ecosystem, staking, DeFi base layer. AI crash may hurt short-term but won't kill fundamentals. Smaller altcoins? Big problems. They are venture. Venture collapses hardest during credit tightening, rate uncertainty, and weak retail. People drowning in credit card and auto loan debt cannot fuel a new alt season. Macro analysts say, we need a business cycle reversal. ISM rising above 50, softer Fed, new stimulus. Many point to 2026 as the potential turning point. Lower rates, end of QT, fiscal boosts, liquidity returns, classic rotation, BTC, ETH, large caps, mid-low caps, no guarantees. Bubbles can live longer than we stay liquid. The US election cycle and Fed composition can shift the path fast. Main takeaway: The AI bubble isn't just about stocks, it's about how fragile the modern financial system is, and why scarce assets like Bitcoin evolved from a speculative toy into insurance against systemic fragility. Friends, thank you for watching. Like and subscribe, leave comments, and remember, this is not financial advice, just my view of the market. If you want me to review your favorite coin, write it in the comments.